Hi, good evening everyone. Thank you for joining us today. In today's webinar, we aim to address most of your investment related questions and concerns regarding the current market condition. To provide valuable insight, we are pleased to invite Mr. Nishit Master. Nishit Master brings nearly 2 decades of expertise to the financial service industry, currently outshining as fund manager at Axis Securities Limited. Known for his deep market insight and strategic approach, Nishit has built a notable career with leading firms like ING Investment Management, Kotak Mahindra Bank, and Motilal Oswal Financial Services. He is mastering both buy-side and sell-side operation. At Axis Security, Nishit focus on delivering a superior risk-adjusted return, making investment strategy tailored to customers' need. His tenure as a senior vice president and head institutional equity at Reliance Security showcase his leadership and strategic acumen in managing institutional investments. With MBA from Narsimunji Institute of Management Studies, Mumbai, and certified financial risk manager, Nishit has combined academic rigor and practical expertise. His ability to identify a high potential investment and navigate complex market situation has made him a key contributor to success of the fund under his management, reinforcing his reputation as a trusted leader in the industry. Without further ado, let's welcome Mr. Nishit Master to share his insight and address investors' concern regarding the current market situation.
Thank you, Samir bhai.
Nishit bhai, this date what we have seen is most of our investors are having one question in their mind. That is, recently recently the market have been under significant pressure with noticeable correction, and October we have saw 17 out of 22 trading session ending in red, and November followed similar pattern, around 12 out of 18 session closing lower. What are the key reasons behind this downtrend?
Okay. So, a couple of reasons why we saw a correction over the last few months. One is that result season was not that great. Q2 results were lower than expectations. We saw a downgrade for overall Nifty earnings estimate. This was the second consecutive quarter where we have seen downgrades in earnings estimates for Nifty 50 companies. Apart from that, we had a big event globally, which was US elections. And, if market participants sense that there is uncertainty, the best thing or the most likely thing which they'll do is essentially go back to their home market. Because you and me, like anyone else, would tend to assume that our home is the safest. It's called home country bias for investors globally. So whenever they sense certain volatility, uncertainty, they typically move money back to their home. And that's what we saw over the last few months, where investors typically sold emerging markets, including India and China and other emerging markets, and took money back to their home countries, which is either US or Japan. And that's why you saw inflows in US and Japan, while you saw outflows across all emerging markets. These are the two reasons mainly, and apart from, obviously some uncertainty for state elections, which was also there, which led to correction, which we have seen of late. But according to me, all these events are now behind us. So, we should be in a steadier stead now.
Nishita, we last 2 months, couple of months, we have seen that FI have been an aggressive seller, right? And is there any specific reason apart from the US election? And will this trend continue ahead, or there is a chance of reversal? Because you know that FI being a crucial investor or maybe market driver, and last couple of months they were aggressively selling. We have seen of lately they have started buying again. But do you really think that this trend will continue over a period of time?
Yeah. So see, as I said, the biggest reason was US elections, why FPI sold. But before that, also we started seeing some FPI selling because India was amongst the best performing markets earlier. Valuations had gone down, and during that time, you saw China trying to inflate themselves or outspend and start growing their economy, which obviously didn't materialize. So initially, you saw a move from India to China. That was a short-lived movement, and then FPI sold across emerging markets, including India and China. Money went to US and Japan. Now, since those events are behind us, except for now, say Donald Trump taking over as the president of US in January, but it's final, right? So in terms of uncertainty, there isn't any except for whatever policies he might announce in future. Because most of that uncertainty is behind us, now you should at least see significant lower selling, if not outright buying from FPIs. Over the last couple of days, we've seen net buy figures from FPI. If they continue, great. But even if they don't continue, if we just do not see the selling we've seen before, sheer domestic buying or DII buying can take the market ahead. So, on the base case, I would expect at least the selling should stop from FPIs. In a bull case scenario, if the buying comes back, and that's what we've seen over the last couple of days, if that comes back, you will see a very strong movement in Indian markets as well.
So Nishit bhai, just one question, which now as an investor, I'm asking personally. Say suppose the way in last couple of months, FI has sold close to 1.5 lakh crore. Just a second. FI have sold close to 1.5 lakh crore securities, right? What if they invest again? Where do you see Nifty is going?
So see, I would not hazard a guess on Nifty, but what I would see again, if I see the last 5 years, the 1 year forward average multiple for a P multiple for Nifty is close to 19 times or 18.8 times. We are at around 20 times right now. So we are not significantly ahead of historical numbers. If I see last 5 years as a history, but we are still at a premium. So I would not hazard a guess in terms of, or at least I would not hazard an expectation that we'll get further re-rated. My expectation or base case scenario is that we continue to mirror earnings growth, which over the next few years on a CAGR basis could be could be around 12 to 14%. So from an index level, I think you should safely assume 12 to 14% kind of returns, provided you stick in the market at least for the next 3 years.
So that's great. So Nishit, I just in first question you said we have seen Q2 earnings season of Indian companies that has not been very great, right? What are the main reason for this, and what can be expectation for Q3 or maybe next financial year down the line, next 2-3 quarters?
So see, consumption has slowed down since some quarters now, especially rural consumption, and that continued in Q2 also. But the thing is that now we'll start seeing fresh momentum on rural consumption, especially because the monsoon has been fairly decent this year. Apart from that, a lot of state governments are giving rollouts to their population, which ultimately will lead to higher consumption. But more importantly, the reason why the last 2 quarters we've seen downgrades, Q1 as well as Q2, which was the last quarter, is because of elections, according to me. So whenever there are elections, before elections, 2-3 months before the election, governments actually stop functioning to a great extent. They do the bare minimum because of the election preparations, and it's a big machinery. So once it stops, you take a lot of time to come back again. And that's what we've seen in the months of April, May, June, July, August, September. To give you a point, typically in the first 6 months of a year, government would achieve 40% of its fiscal deficit target. And that's been a history for many years or decades. This year, we saw government achieving only 30% or less than 30% of the fiscal deficit target in the first 6 months, which means government has not spent. Now, any government department which has been allocated money, what will happen is if they don't spend that money before March end, the money goes back to the central kitty, which no government department likes. So they will spend that money in the next 6 months, which starts from October, November to March. We've started seeing signs of that. Earlier, construction companies were not announcing orders. Now you've got you've seen spate of orders for construction companies, for defense companies, for capital goods companies, which means that spending has started picking up. My personal view is that typically analysts work on Excel sheets, so they think that everything is linear. And you saw 2 quarters of downgrades, so their expectation for third quarter is also actually very low. According to me, if things go right or things go according to how I foresee, you could see an upgrade in Q3 because of sheer momentum of government spending, and which obviously then translates to private spending. Apart from that, I don't expect a rate cut by RBI, but even if
So, Nishit, for I being a retail investor, I always feel suppose in case, as you already said, RBI will not cut rate tomorrow. What if what will be implication on the market? Do you see PSU or maybe private banks are going down for next quarter or?
Okay, so see, the expectation from the market is that RBI will not reduce rate tomorrow. If that happens, it's already priced in. If they reduce rate, that will be a positive surprise for the market. I also don't believe that should happen. If they actually ease out liquidity conditions in the market, either through a CRR cut or something else, open market operations, then actually it's positive for PSU banks, especially because they are sitting on excess SLR. So they have a fairly strong case for some re-rating to happen. Private banks also should benefit out of it, but not to the extent of PSU banks. So if it's a no rate cut and no CRR cut, then I think it's already priced in the market. It's not a net negative. If there is a CRR cut, especially, again, I'm not forcing a rate cut, but if there is a CRR cut or open market operations which are bigger in size to ease up liquidity scenario, then I think it's net positive for the markets. Market should take it positively.
Okay. So, Nishit, the another factor which is really impacting our market is that we have seen rising geopolitical tension in Middle East and Ukraine-Russia war, which is happening since last 3 years now, and of lately we have seen a lot of spike, a lot of aggression coming to that war. Do you see what do you see how that war will impact further on our market? What are the possible outcome ahead of in case if say Middle East tension rises or maybe Israel Palestine war or maybe Israel Iran war, if that gets spiked up, how it will have an impact on our market?
Sure. So see, I'll divide the answer in two questions, right? One is the Middle East scenario. The other one is the Russian-Ukraine war. As long as the Middle East scenario is under control and it does not lead to supply shocks on oil, we are fine. Even if that conflict keeps on going on, as long as it does not have an impact on oil prices, India is fine. We don't have anything to worry about. So neither Israel nor Palestine are major players in the crude oil or gas market. So if the conflict is restricted to those markets, then I think Indian markets don't have anything to worry about. If the conflict spills over to Iran, which leads to crude prices going up significantly, and when I talk significantly, then I'm talking of crude above say $9,500. Then, as an investor, one should worry because then we'll have to forget about rate cuts. We might have to relook at rate hikes at some point in time because crude will then have an cascading effect on everything else. But as long as that does not happen, then Indian markets are more or less safe from that angle. Now, going back to the Russian and Ukrainian crisis, uh, according to me, we are at the fag end of this crisis. There is a incoming president in US whose stated objective is to complete or do away with this war. And to a great extent, it's been US which has been instrumental in this war continuing further by supplying arms to Ukraine. If that was not the case, then this war would have ended long back, and there would have been a peace treaty. So, if the incoming US president thinks that it's in US interest to to wind down this war, the winding down will happen. And if that happens, and then the follow-on, which probably will take a few months later on, will be lifting of sanctions on the oil and gas industry of Russia, then you will probably start seeing the entire energy complex pricing coming down, which ideally is very good for India. So, if crude prices, gas prices come down significantly, and to a great, actually, Russian crude is not out of the market. India has been a big buyer for Russian crude, so is China. But still, Russia can still increase capacities and supplies gas, especially to Europe. That will lead to overall inflation scenario coming under control significantly. So, that on negative, obviously, our crude price will go up because we're getting cheap crude from Russia. But overall crude pricing or Brent prices should come down, which is good for the overall global economy. So, as long as crude does not spike, and that could happen only if the conflict in Middle East spills over to Iran, we are safe on geopolitical front. On Russia, net, I think the only thing which can happen positive, is positive rather than negative. Provided the current US administration does not escalate matters before Donald Trump assumes the presidency.
Coming back to our home, India's GDP growth rate stood at 5.4%, and it is like 2 years low, right? And the inflation has also shoot up of lately. Just want to know how will be how will the situation ahead? You see basically how India will shape up, maybe 5.4%, 5.4% GDP to increase our GDP rate, growth rate. What all measures our current government will take, and how it will have an impact on our Indian economy, or maybe on a stock market.
Yeah. So see, as I said, this 5.2% or 5.4% GDP print is an aberration according to me. It's because of elections mainly. And as I mentioned earlier, that you will see second half being very strong in terms of government spending, and that's how I believe that this 5.4% is a bottom. Q3 should be better than Q2, and Q4 should be better than Q3 in terms of GDP growth. But this is a post facto GDP growth number, right? Because it's Q2 GDP growth, and that is obviously up for it will also get revised over a period of time. But more importantly, Q2 earnings are already out. So this 5.4% GDP growth is already in the price because the earnings for that quarter is already out. And as I said, right, I believe firmly that Q3 should be better than Q2 because government spending has picked up, and Q4 should be better than Q3 because seasonally also Q4 government actually spends the biggest amount. And with government spending, you will also see ease of liquidity scenario, which is good for entire private space and also private capex picking up. Because already we are at significantly higher capacity utilization. Private capex to a great extent was also stuck because of elections, and if I as an investor is putting 2,000 crore worth of plant or a factory, I would wait for the elections to be over, and if there is for uncertainty to be over before I commit that 2,000 crores of capex. That is also happening right now. So you will see, according to me, you'll definitely see Q3 better than Q2 and Q4 better than Q3 also. This 5.4% GDP print was a aberration. Things should improve from here on.
So, as a retail investor, which sector I should keep an eye on it, right? And which sector will show a strong reversal once the situation improves?
Yeah, so as I said, right, I am still bullish on the capex cycle. So, and with government funding picking up and then private capex also picking up, expected to pick up, I believe capital goods and industrials are one space which you will see traction going ahead. Apart from that, pharma continues to do well. The US market demand continues to be robust. The pricing pressure for generic pharma in US is actually fairly low. Typically, we had moved to around 6 to 7% price erosion annually. Currently, we are at around 3 to 4% annual price erosion, which actually is good for Indian pharmaceutical space. And again, with the whole Biosecurity Act coming in, Indian pharma is expected to do well at the cost of Chinese pharmaceutical names. So that's a space which we continue to like. We continue to like the hospitality space where the demand continues to be very strong. You look at you try and book any hotel rooms. The rates are off the roof. But in spite of the rates being so high, occupancy is also inching up. So it's actually great for hotels or travel and tourism space overall. So these are the spaces which we continue to like. There are some areas of concern. So we started seeing some slowdown in auto demand. That's an area of concern for us. IT is not picked up to the extent of expectation, though the sector from the stock market perspective has done well over the last 3 months, but the demand scenario is not picked up to the extent where people were expecting. So that could pose some negative surprises going ahead. But yeah, from sectorial allocation perspective, I believe industrials, capital goods, pharmaceutical, and hospitality would be my key focus areas.
Okay, that's great. I guess this will definitely help investor to keep eye on those, or maybe top-notch stock of that particular stock sector. Now, Nishit bhai, as a retail customer, generally this is a typical behavior of a retail customer, where when markets are down, they hardly invest, right?
Yeah.
They are shying away from investment during that phase. And when once market is in a bounce back trend, or maybe again, a market is touching a all-time high, that point in time, they generally come, right? As a retail investor, in such market, such situation, which is happening in present market, right? What kind of strategy they should adopt so that they can make actual money?
So see, two things which are very important in the market. One, obviously, the research quality which you. So if you're in a retail investor, even if you have time, then ideally you should research on the stocks you're buying. If not, then you actually need to rely on an advisor who is competent enough to give you an advice on what to buy and what to sell. So that's important. But equally important is discipline of investing. So according to me, you should invest in equity markets only if you have a long-term horizon. That's where you can generate significant wealth for yourself. So, and that's a discipline which one needs to get in as an investor. And I'm not talking of traders right now, I'm talking of pure investors. So discipline and capability both are important for investors. And if both of these are there, then I think there is a significant strong chance of you generating significant wealth over the next a few years or probably decades, because India will continue to grow. So will Indian corporate sector and corporate profitability. It's a market where one needs to be invested for a longer period of time to get the maximum possibility of generating wealth. And as market gurus have said, right, it's better to be fearful when everyone is greedy But when everyone is fearful, it's better to be greedy.
Yeah.
It will increase your chance of making money significantly.
So you have rightly pointed out how investors should behave now, but most of the time retail investors hardly get time to do their own research. In such situation, right? If retail investor really wanted to do a research or they wanted to identify their stock, what are the basic parameter which they should look so they can invest for a longer period of time? Generally, what happen when investor comes, they have a very short horizon. But as we always say that long term investor can only make money. So if they wanted to really be a long term investor, what 3-4 parameters ideally they should look for?
Okay, so I'll just, some basic screeners which one needs to be aware of. One, that, you bet on the right people or the right promoter who's running the company. Because if you don't bet on the right promoter, even if the company does well, the minority shareholders will not get anything. So you bet on the right promoter, which is very important. Second, you bet on the right industry, because the best of the company in an industry which is not doing that great will not make money for you. So you bet on the right industry. And third, you bet on companies which have the capability or which have the underlying capability to achieve sustainable growth. And you pay the right value for it. So these are the 4 things which you need to look at. Company's ability, or do they have a certain right to win in that industry? Do they have the capability to service their clients' needs at a reasonable price or a reasonable cost? And are you paying the right price for that particular company? This, apart from the promoters of the company being genuine, and the industry being in vogue or the industry doing well. I think these are the 4 basic things one needs to look at. Apart from, obviously, then you can go a lot deeper into it. But for preliminary investigation, I think these are the 4 things one needs to look at before buying a particular stock.
Thanks a lot. It was a really great input, and I hope investor can actually follow this tip and they can identify the right stock for them for their portfolio. Now, when we talk about portfolio, right, in such situation, what is the what is the ideal portfolio allocation investor should have in that in current market situation?
So see, each individual will have a different portfolio allocation strategy based on their risk appetite, based on their investment horizon, based on their age and their requirements for future. So I think rather than a general answer on portfolio allocation, I think one needs to look at various parameters of an individual, including, say, the age, risk appetite, investment horizon also, which is very important, and what are your future goals. And if you don't have the capability to marry all these together and come out with a portfolio, then ideally you should look at a portfolio advisor who can give you a right allocation of portfolio mix. But typically, right, on a broader level, invest money in equity only if you have at least 3 years of horizon. If you're looking at if the money is available only for short term, then probably a debt market product is useful for you. Some money should be in, say, gold, because that gives you some kind of an inflation hedge, but also some kind of insurance against geopolitical shocks and stuff like that. So some allocation should be to gold also, but ultimately the allocation across various asset classes should be determined by your own factors, including your age, your risk profile, your investment horizon, etc. And you can take advantage of portfolio advisors who can actually give you the right advice for yourself, and which would be customized to you rather than a general answer for everyone.
Yeah. So I guess this is a really great input. Nishit, I just wanted to ask one question. See, when we talk about equity allocation, right? Again, in equity, large cap, mid cap, and small cap, 3 categories are there.
Yes.
Generally, what we have seen is retail customers are always overboarded on mid cap or small cap stocks. So according to you, ideally, what percentage they should invest in retail, small cap, mid cap, and large cap? I guess that can have a fair bit of understanding, or maybe it will help them to mitigate the downfall risk.
Okay. So see, again, there is no one answer to this. If I'm young, say if I'm 30-year-old, and I don't need the money for the next 20 years, a big part of my allocation can be in small caps because, I can take risk. If I'm someone whose income has stopped, I have some wealth with me, but my income has stopped because I probably retired. I need more steadier returns. A large cap oriented portfolio probably works for me. So it's a combination of all. It's a combination of your where in life you are, right? Sorry. And what is the risk appetite you have before deciding your allocation for small, mid, large. But generally speaking, over a period of time, if you have a longer horizon, say if you want to be invested in equity markets for 5 years, 10 years, then my guess is that probably small and mid cap would do better than large cap. Right. But if you don't have a longer horizon, you have a horizon of 2, 3, 4 years, then probably you're better off investing in large cap than small and mid, because the volatility in large cap will be lower probably than small and mid. But again, these are just broad indications. The final decision will be based on risk profile and your investment horizon.
So, in nutshell, first you have to investors to understand risk taking capability, time horizon, and then they have to decide the allocation between large, mid, and small.
And small and equity, debt, and gold, whatever.
Okay. So further asset allocation, he can based on his allocation, risk appetite, and all, he can decide.
Yes.
Just now you said we talked about gold. Gold has been like a shining light in recent, you have seen in recent past when equity was falling. Gold was the only instrument where we have seen some bit gold and silver. We have seen some bit of spike. Now, what is the outlook ahead for all precious metals, maybe gold or silver? Where do you see, as an investor, should I keep investing, or should I? This is the time where investor need to have a cautious approach.
So see, I am not an expert in gold or precious metals. So, my 2 cents on it, and don't take it as an expert advice, it's a personal advice, that one should have at least some part of their portfolio in precious metals, especially gold. And gold has become a lot more important asset for investors now, especially because when, say, a big country like US imposes sanctions on another big country like Russia, there are a lot of countries who would not want their reserves to be in US dollars. Any country who does not have a great relation with US will not want their reserve assets to be predominantly in dollars. They will diversify in other asset classes. So they'll diversify into euro, pound, yen, renminbi, but they will also diversify in gold. And that's how in the last few years you've seen gold doing exceedingly well, because a lot of central banks globally have been buying gold. This scenario will continue for some time. And thereby I believe that gold has a bright future. It's been a volatile asset class, but still, I personally believe it has a bright future. One should have at least a small allocation to gold in their portfolio.
Okay. There is one question from, I guess we are done from our side. Okay. We have collected a lot of questions from our investors, and we try to cover before they ask. Now, there is one question coming from Pradeep, right? He is asking if any war situation happens, then it is a chance to price share of oil companies, ONGC and Reliance.
Okay, so see, each individual oil company operates differently. ONGC, typically you can assume that government will cap their realizations at around $80. So anything beyond $80, the government will cap their realization. That's a basic assumption one can take before buying ONGC. So sweet spot for ONGC is crude being somewhere between $75 and $80. That's a great range for ONGC, and that's where earnings will do well for them. For Reliance, the call should be, how are the refining margins moving globally, and how is the petchem margins moving? And this I'm only talking of their oil and gas business. Now they have a telecom business which is equally more important, and they have a retail business which is also equally important. So Reliance is a bigger conglomerate from from a business perspective, and you'll have to look at all the three businesses, which is oil to chemicals business, which also has the refining and the petchem business in it. You look at retail business, which is again a significant part of their overall valuation, and you look at the geo business, which is the telecom business, which again is a significant part of their valuations. So you'll have to take a call on all three before actually investing in Reliance. ONGC, as I said, right, the sweet spot for them is crude being between $75 to $80. That's a sweet spot for them. If the crude is at $100, I believe that government will take big part of that realization from ONGC as, say, some kind of taxes, which happened also earlier, where government imposed windfall tax on ONGC. So anything beyond $80, one should not assume that ONGC will be able to, take benefit out of that. In terms of OMCs or HPCL, BPCL, IOCL, typically lower crude prices actually benefit them. Except for one-time inventory loss which they might take on their books, but their ability to pass on or get higher marketing margins improves significantly at lower crude prices. So typically lower crude prices help OMCs.
Nishit bhai, this was a really very insightful answer. Now there is one question from Mr. Kaushik. He is asking that what is the future of chemical and real estate sector?
Okay. So real estate companies continue to do well. There are some rumors of a slowdown happening, but we aren't seeing. We're just seeing initial signs of it. Probably it could be election driven, where transactions stopped, especially in Mumbai and Delhi. We'll have to see, how things pan out. But a lot of launches planned by real estate companies across India, the bigger real estate companies. So it's definitely a space one needs to look at. But you need to pay the right value for it. We've seen a fairly strong run-up with a lot of real estate companies. So one needs to be wary of the value you're paying for that company. But apart from that, I think we are in an okayish cycle right now from real estate perspective. Chemicals currently is facing a huge issue. Chemical prices have been under pressure because of dumping by China globally. Tomorrow, if US imposes significant amount of duty on Chinese imports, then you could see a revival on the chemical industry, even for Indian chemical manufacturers. But that's dependent on US actually putting up huge duties on China, which Trump has promised. So that his campaign promise was 60% import duty on all Chinese imports. It's difficult to implement, but if it gets implemented, then you could see, Indian chemical companies also doing well.
I guess Nishit has answered really well, and that was in depth. Now there is another question from Mr. Pradeep. How can we identify that this is the right price for stock? So basically, he's asking for whether price is right, and how to decide the price of stock in price of stock scenario. So basically, he wanted to understand.
So right price, okay. So
the right price.
It's all relative and absolute both. So you look at historical multiples. Is the current stock price trading at those multiples? Second, you look at relative valuation. So premium or discount versus Nifty or the sector. These are again. So that's a relative valuation. Third, you look at the trajectory of the earnings. Is the trajectory or the growth improving or growth slowing down? If the growth is improving, then you can still give a premium to historical multiples. If the growth is slowing down, then ideally it should go to discount to historical multiples. And fourth thing is, are the companies becoming more efficient? And the way you look at efficiency for companies is essentially look at their ROEs or ROCs. How efficiently are they utilizing their capital, either equity or overall capital? If they're becoming more efficient, then ideally they should get higher multiples for the higher efficiency. So it's a very long topic in terms of valuation, but I've just tried to simplify whatever I can in the short period we have.
No, that's a really great answer because it was really insightful. It was very simple to understand, and I'm sure they can practically use the tips which you have given. Now, there is one question from Paramjit. He's asking, are the US market overvalued? Is there a bubble that might trigger a global sell-off in near future?
So Paramjit, I am not I'm not an expert on US markets. I don't look at US markets very keenly or closely. But what I can say is that unlike India, where we've seen over the last few years, we've seen a broad-based rally. US market has been more top-heavy, where 5 to 10 names have actually led the markets up. It's not been as broad-based rally in US as what we've seen in India. And typically, if rallies are led by only a few names, then it's not as healthy as rallies which are more broad-based. So that's the general brief I can give you on US. Yes, if there is a big sell-off in US, it will have a rub-off effect on all other markets, including India. But as long as our fundamentals remain intact, that correction will be bought into, and we'll see a quick bounce back also. But if it impacts our fundamentals in terms of our growth going down significantly, or India also seeing a recession, then obviously Indian markets could correct for a longer period of time. I don't foresee that right now. But as I said, right, I'm not an expert on US markets, so take my comments on US markets with a big pinch of salt, actually.
No, that's great. Nishit bhai, now we'll take only last question as we are running out of time. This question coming from Naushad: what will be the impact on IRDA if RBI revised interest rate?
So see, I will. You've asked a question on IRDA. I would refrain myself from giving comments on individual stocks. I'll stick to sectorial calls, which I can give. But I'll refrain from giving individual stock suggestions.
Okay. Nishit bhai, thank you so much. It was really wonderful interacting with you. And you have given a very insightful information to our investors and customers. And I'm sure they'll use in very constructive manner and they can make money out of market. And the best suggestion which you have given is before investing, you should be always develop a disciplined approach and remain invested for a longer period. Despite of market volatility, market will definitely generate a good return over a period of time. That is a piece of advice which every investor should definitely follow. That's all from our side, guys. Thank you so much for joining us again, once again. And we will definitely let you know if for the future such kind of informative webinar. Do join us. Thank you so much.
Thank you so much. Thank you.